and you have, yeah, and you have, stock exchanges operating. Okay, we will look at these things in detail. Let's go ahead. Right. Meaning and definition of investment, characteristics of investment, what determines your investment. Okay, then ways and means for investment, all this. Okay, meaning of investment. Frequently these days you get calls from the telecallers. Sir, there is a plot in Shamirpet. There's a plot, there's a venture going on in Shamshabad. Gone are the Shamirpet and Shamshabad, okay, Hayat Nagar, and people are going beyond these border districts of Hyderabad, border towns of Hyderabad. Now they're going beyond that, right? Then I don't need anything because I have already house. I don't need anything. No, sir, for investment purpose, you can buy a plot there, right? Now, we are not talking about those investments. We are talking about, look at this. Yeah, we're talking about the purchase of financial asset. Purchase of financial asset. Okay. And this financial asset is not, let's say you pay money and you get the land. There's a direct relationship. But when you are putting your money in the equity, what is happening to that equity? Or when you're putting your money in the bonds and debentures, which is called debt market, what happens to that money? That money is invested in productive facilities. It may be any kind of productive facility, or it may be just rendering some services. For example, in companies like IT companies, and in some cases, healthcare industries, or like hospital, it's not a company which produces, it provides this service. And they need money to set up the buildings. They need money to set up the equipment. They need money to pay for so much of material that they procure for treatment, including cotton waste, okay, and disposables, all those things. For all those things, they need money. And that money is raised from the capital markets by various means. And that money is supplied by people like you and me in the form of shares and debentures. Those shares and debentures are financial assets. Okay, keeping my money in a debenture or equity, okay, is investment into financial assets. Simply, yeah, the investment is purchase of financial asset like equity, bonds, debentures, okay, and so forth. Now, one more definition is investment is meant by an addition to capital that occurs when a new house is built or new factory is set up. You're buying financial asset, okay, like equity, shares, and the money raised through shares are invested in setting up a new factory, new building, okay, new equipment, new facility, right? So by which what is happening, somebody was asking, there is a lot of wealth amassed by so and so persons. Whatever be the wealth amassed, a man can, for his personal use, can consume not more than 1 lakh per month, whatever be the highest level of consumption of all luxuries. It will not be more than 1 lakh. In a year, 12 lakhs. Okay. So most luxurious way of spending money. In spite of that, there is some more money. And if you think that he's amassing wealth, how much do you think that he has? Sir, he must be having not less than 1,000 crores. Okay. If all his consumption for the year is 1 crore, still 999 crores are there. what is happening that 999 crores? That is, no, sir, he is purchasing buildings. He's setting up the companies. He's amassing wealth like anything. What is all that? He has kept his money in the properties, assets, which generate employment. Okay, though I appear to be amassing wealth, what I'm doing with that wealth, I'm putting it as an investment in the company, in the business, and that business generates employment. And that employment results in prosperity in the economy. Okay, that results in prosperity in the economy. Now, the problem is, yeah, when this money is stashed, hoarded in, idly in the ground or in the washrooms and things like that, that is dangerous to the economy. Money should be circulated. As it is being circulated, then the economy, economy yields prosperity. There's one gentleman, financial analyst and an equity expert, okay, a professor of finance, Sharpe, who defines the investment as a sacrifice of certain present value of some uncertain. Look at this. What he says is, I'm just setting aside little money for my future requirements. Okay. And why I'm setting aside? Because the future is uncertain. Okay, all those set aside money is the domestic savings. The domestic savings will become the corporate's, corporate's capital, right? Therefore, investment is commitment of funds towards purchase of financial assets. My domestic saving, I will be using to buy the financial assets which yield return over some future period of time. Yeah, Bitcoin or cryptocurrency is not legal in India, but some time back when I was teaching to some of my postgraduate students, okay, in a particular university in other countries, he came and told me that, suggested me that to invest in the bits. I was the finance teacher, that concept was new. It's very long back. The concept was very new to me. Theoretically, I know, but practically, I have never invested in Bitcoin, and I was totally new to that. I'm talking about 10 years ago. Then he said, how much should I invest? So each bit, in Indian rupee terms, it comes to 5,000 rupees. 5,000 is huge amount, I said, but in 3 years span, that 5,000 became 70,000 in Indian terms. Okay, so look at this. Yeah, this has yielded a return. So many times return it has yielded over a period of time. In 3 or 4 years time, 5,000 became 70,000. Now I'm working for a corporate where when it has gone for listing, it was listed soon after it was listed, it was trading at 800 per share. Now, within 12 months of time, it has gone up to 1,296 rupees. Okay. Then 1,600 by 14 months, it reached 1,600. Look at this. 1,600 it became, more than double it has yielded the return. Okay. So it is an investment, committing the funds towards the purchase of financial assets, which yields return in future. Right. The major difference in the use of the investment in the economies, in the investment in economics and finance is when you're talking about economics or economists, okay, they say if you are keeping your money in any real asset, that is investment. But they say financial investment is not a true investment, but we are going to talk about those financial investment. Right. What are the characteristics of investment? Number one, return. Yeah, there may be a question. Features of investment. Nature or features, it is the same question and the same answer that you have to give. Return. What is return? It is an invest. Yeah. Every investment. Uh, if there is anything that you want to say, okay, please open up your mic and speak to me, because I may not be able to check the chat box. Okay, so if you have anything to say, just message me in the group or directly. Right, we'll proceed. Yeah, return. Every investment gives some return. There's an expected return. Yeah. And your objective, your intention to invest is always to get some extra money. If I'm keeping 10 rupees, that 10 rupees should become 20 rupees, or if not 20 rupees, 10 rupees should become 12 rupees. Okay, there's a good old saying. There's one landlord, he was going out of station. And while he's going out of station, he called 3 servants. Okay, he called his servants who are supervising over his household. He's a big zamindar kind. He called the first fellow and said, yeah, you take these 10 talents. Talent is about maybe, yeah, about 100 kilograms of gold or so. I don't know. So he gave 10 talents and said, yeah, keep this in your custody till I come. Another man, he gave 3 talents and keep this in custody till I came. Okay, and give me when I come back. Another man, he gave 1 talent and he said, keep it. All 3 he gave. 3 people were given 3 different responsibilities. Okay, 5 talents, 3 talents, and 1 talent. 1 talent is equal to 100. 1 talent is equal to 100 kilograms of gold. Okay, it's huge amount of investment. So he went away, and after a few months, he returned back, and then he was checking back what all the responsibilities that are given. He wanted to check back whether his wealth is safe or not. He called the first fellow, hey, I gave you 5 talents. What did you do with those 5 talents? Yeah, master, you are so kind and you trusted me and gave me 5 talents. And here is your 5 talents. Not only this, sir, I have made 5 more talents using this 5 talents. So your 10 talents, sir. Then the landlord, the zamindar, was so happy. Yeah, well done, thou faithful servant. You have been faithful in small thing and be over the master of many things. Now I'm going to make you in charge of so-and-so mandal or so-and-so estate. Then he called the second one and, hey, what about you? He said, master, you gave me 3 talents and I doubled it. Now here are your 6 talents. That's good. Well done, thou faithful servant. Go and be the ruler of so-and-so village. You are faithful in small thing, and I want to give you bigger responsibility. Now he called the third one and said, hey, what about you? Master, you have given me 1 talent. I know that you are a very cruel master, and you reap where you don't sow. And I was so scared of you. I wanted to preserve your 1 talent. Okay. And therefore, I have hidden all that money that you have given me in the ground. And I just bring it back to you. Here is your 1 talent. And the master was so furious and said, you unfaithful, you lazy fellow, lethargic fellow, knowing that I'm a person who reap where I don't sow, you still didn't do anything this 1 talent. You didn't use your mind at all. Okay. So then you are not even worthy to hold this 1 talent. Give this one talent to the one who has already 5 talents. Let him multiply. He's good at multiplying. So this is the story. The moral of the story is when money is entrusted into your hands, you should multiply it. If money doesn't multiply by itself, there is something wrong. We are not using it properly. Okay. So every rupee that is entrusted to us, it has to yield fruits. Okay. During the Great Depression of 2000, Great Depression is 30s, and in our time there was a depression. Okay, in our time there's a depression. That depression is 2008 depression, subprime depression. It has shaken all over the world, but it didn't shake much. It didn't shake the Indian market much, because the Indian market is resilient to any sudden shocks. Indian market is very strong and sound because our systems are in full proof. Okay. So during that crisis, people lost money. The stock market lost so much money because the foreign institutional investors have withdrawn money from the market. When it was withdrawn, the market collapsed from 20,000. The Sensex collapsed from 20,000 mark to 10,000, even 8,000 came just in a week's time. So then somebody was pointing out the fund managers of the mutual funds. They said, we cannot give more than 3% return. And look at this. This 3% is not per month. This 3% is for the year. 3% per year. One financial expert was saying, the fund managers gone crazy, and they don't have any clue how to make good returns for the investors for the money that is committed into their hands. Okay, so money is given into your hands. Our hard-earned leftover savings or set aside savings are committed into your hands. As an investment manager, fund manager, or man dealing with our financial assets, you should be careful. And if you're not careful, then you will use that money without using your logic and wisdom, and without understanding the fundamental forces operating the market. As a result, the returns may be declining. Okay, so fine, I'll come back to the return. Any money that is put as an investment should give some extra money. That extra money in the story, okay, 5 talents given, 5 made. That 5 extra is a return. 3 talents given, 3 talents more made. That extra 3 talents is return. 1 talent is given, nothing is made, there is 0 return there. You call this extra money with any name. You can call it dividend, you can call it interest, you can call it, anything. The appreciation in the money supplied, the appreciation in the capital supplied is return. You call it interest, you call it dividend, you call it coupon, anything you call, but that's an appreciation in the capital. Just in the story, 5 talents became 10 talents. There's an appreciation of capital, right? Just like that. Then risk. Risk is another feature of investment. Yeah, I'll hold it here. I think I have 3 students in the class. Yeah, 3 students, 2 students. 1 student left, and 2 students are there. May I know your names, please? May I know your name?
Maunika, sir.
Maunika. Okay. And second one?
Harita, sir. Harita.
Harita. Okay. Are you able to hear me, ma?
Yes, sir.
Are you able to
Yes,
follow
sir.
me?
Yes, sir.
Yes,
Yes,
sir.
sir.
Okay. And wherever you are not able to follow me, please do stop me. Okay. Raise the question. I will explain to you.
Sure, sir.
Okay, don't hesitate to
Okay.
ask the question. Okay.
Yes, sir.
Okay, you can mute yourself unless you have a question. If you have a question, then you unmute and speak out. Right, you can mute your mics.
Okay, sir.
Okay. Yeah, we'll continue. Then risk. Now, risk is something unexpected. Okay, the unexpected return, you don't call it risk. Okay, when you see something unwanted happening in future, okay, then that is risk. Okay, now if that unexpected thing if that is favorable, that is surplus you call. But if unexpected thing is negative, then you call it risk, right? The risk of the investment is relating to variability of returns. That variability, if it is favorable, okay, we are happy. There's something called principle of conservatism in accounting. Those who are taking finance might also have done your accounting in semester 1. So there's a principle of conservatism. What is that? Anticipate gains, but don't anticipate losses. Okay. Anticipate losses, don't anticipate gains. That means when you're starting the business, when you're committing the funds into somebody's hand, you have all doubts and suspicion that this may go wrong. Okay. And based on that, you bargain for the interest rate. Okay. Let us say if you see the money lenders, right? And if even the bankers, if the credit profile is very good, people get surprised if I get a personal loan at 7%, 8%, 9% also. Bank interest rate 9% personal loan is very rare, but it is very surprising because my credit history is clear. Therefore, the banker finds no risk with me. Therefore, he gives me at the lowest interest rate. But if there are some troublesome, if there are some CIBIL score is somewhere around 400 or 500, it means there are a lot of defaults in the past, and this man has a bad credit history. So therefore, giving him is risky. Okay. At that time, the interest rate is 17%, 20%. And even those people, even if it is 20%, they take it because they don't have an intention to pay it back. So banks and financial institutions also, they're in such a, such an analysis mode that these are the people who are in dire need of money now, and there is high risk profile. Let me charge more and more interest rate. Okay, I'll come back. Risk is associated when you are giving your money to somebody. వస్తే తీసుకో నీది, లేకపోతే అది వాడిదే. నీకు ప్రాప్తం ఉంటే నీదైతే నీకు వస్తుంది అన్నట్లుగానే ఇవ్వాలి. Risk is associated with the investment, and this risk is more with a longer period of maturity. Okay, if you are giving that money for 1 month, then risk is less. For 1 year, little more. 3 years tarvata istanante, even more. Higher the maturity period or longer the maturity period, larger is the risk. Okay, lower is the credit worthiness. I told you just now, if higher is your CIBIL score, okay, higher is your CIBIL score, your credit worthiness is high. If your CIBIL score is low, your credit worthiness is less. And when your credit worthiness, if your CIBIL score is less, you have a, this particular application or profile is high risk application or profile. So risk varies with the nature of the investment also. Okay, like, equity has highest risk, debentures less risk compared to equity. Then commercial banks less risk compared to debentures and equity. Okay, then government securities, even less risk. Fine, there is a risk return, then safety. When you're committing funds to somebody's hand, you look at the safety of your money, whether you'll get it back or not. Okay, safety. Then liquidity also, how fast I can convert my investment into cash. How faster I can convert into cash. An investment which is easily saleable, marketable is said to be processing liquidity. Okay, easily convertibility is known as liquidity. Okay, transferability of financial asset like equity, bonds, debentures, easily into money terms is liquidity. Okay, so higher the liquidity, more the people prefer to. Okay, you can buy the share at 12 o'clock, sell it at 1 o'clock. Right, that is the degree of liquidity in the equity market. Then convenience, you should be able to, today, in olden days, people had to go to security exchange or stock exchange to check how their money is growing and fluctuating. But now on the screen, you can observe how and what happens to your money. Then there's a tax advantage, right? And if you are investing in, national savings, NSCs, and some of the mutual fund special schemes, your income is exempted under Section 88 of the Income Tax Act. Okay, and but if it is equity, you have to pay a tax of 30%. Right, once again, the features of, features. There's a tax advantage in the government investment, and the investment, how convenient it is, that you check before you invest, and liquidity also, safety also, return also, risk also. So risk, return, convertibility or liquidity, safety, convenience, and tax advantage. Then significance of investment. Okay, this you can just go through. Then I will take you to, you can just have a look at this. Okay. Objectives of investment. Okay, why people invest? Objectives of investment. Why people invest? 3 basic objectives. Okay, security. Okay, liquidity, yield. If you keep money with you, that is not safe. Why? Friends may ask, relatives may ask, okay, thieves may steal, rats may bite, okay, and the rain may spoil the notes. So therefore, you keep your money, okay, safely in the bank. And if you keep at home, that doesn't yield anything, just like in my parable, that third fellow who has taken that 1 talent. That doesn't give any yield. Okay, so therefore, I want some yield also. Therefore, I keep it in bank, with the banker or with the government or with the industry. Right? Security is primary to the investment, and if you're keeping in the hands of the government, you're always safe. How to keep it? Treasury bills, okay, certificate of deposits, bankers acceptance slips, fixed deposits, all these are safe and secure. Liquidity is one more. Okay, how best you can convert into money. Then yield, it should fetch some additional value to what you're keeping there. Okay. So these are the objectives with which the investors keep their money. Okay. Primary or basic objective. Now, the secondary objective is, I want to avoid tax. If I keep my money, I'll tell you one example. One gentleman has an old scooter gifted by his father-in-law. And another scientist working in a public sector undertaking, he was given the responsibility of selling that old scooter. That old scooter, yeah. Can you just give me a minute, please? Just a minute. Right. So minimization of tax. Tax evasion is crime, but tax avoidance is legal. You understand? So to avoid tax, people invest. Right? And the marketability, you invest in such a way, whether it is real investment or financial investment, you invest in such a way that any time that you're in need of money, you should be able to transfer this ownership and get the money, called liquidity. Right? These two are the secondary objectives of investment: tax minimization and marketability. Marketability, you're able to sell it as quickly as possible, as easily as possible, and get your money. Okay. So these are secondary objectives. What determines your investment pattern is another question. You see, nobody wants to go to African nations to invest except countries like China. Where angels scared to venture to tread down. Okay, some people are daring to go there. That is where China is. All the nations are afraid of the economies, turbulent economies like African countries. Okay, and yeah, if you're sending, hold on. Yeah. These are turbulent economies, and China is so stubborn. The dragon is so fear-free that they go to African nations and put huge amounts as investments there. They build huge power plants. They build, large dams, and millions and billions of dollars they pour in there as investment. And a country like us, even the most powerful capital nation like US, are scared of going there. Right? Whatever it is, the fact that should be understood is you should have a well-organized monetary system so that you get back your money. I'll drive you to one point. I do not know whether you read this in the newspaper because it's very long time. There was one company called GMR, okay, which is running our airport in Hyderabad. And it was given the responsibility. It won the international bidding through the IMF, International Monetary Fund. When it won the contract, it started building, and the government was so happy to award the contract. The IMF was the guarantor for this entire deal. The airport, the Maldives airport, was given to GMR, and they started building. The construction is over. The airport is about to be commenced. About 50 lakh people pass through this airport. That's a target they have set. That is how they have invested. And out of this investment, about 85% is a borrowed capital and only 15% belongs to the GMR. When GMR took this much money and took about 3 years to construct this airport, state-of-the-art, international kind of airport, the government changed in Maldives. When the government changed, the new government came and said, hey, nothing doing, you cannot operate. It is constructed on BOT format. What is BOT? Build, operate, and transfer. You construct it with your money, operate it for some time, and get back your investment. After an agreed period of time, you hand over it to the government. That's BOT. The construction is over, build part is over. They were about to operate. Airport commenced its business. When it was commencing the business, the terms and conditions agreed upon by the earlier government are not, viable for us. We don't want to accept those conditions anymore. Just get lost from our country. Then GMR said, as per the deal, if the contract is discontinued in the middle, you have to pay the compensation. And this is the compensation. I do not exactly remember the compensation. Okay, I read it, but I can say this much. The GMR contended that, this is about these many billions of dollars, which is bigger than your gross domestic product. The compensation that you have to pay me is bigger than your entire country's national product, national income. Where can you pay it for? All that we will take care of you, get out, said the government. Then they filed a case in the International Court of Justice. There's a bench of this Court of Justice in Singapore. When the matter came to Singapore, the IMF was the guarantor. IMF said, yes, what's happening is wrong with the Maldives government. They are not supposed to do that. They stood by GMR. Okay. Then somehow things were streamlined and somehow some amicable, viable solution arrived at with the intervention of the court, International Court of Justice. Fine. What is that I want you to understand in this entire scenario? They could easily say, get out of the country, get out of our country. The new government said, you go out. Simply they said it. But that is not possible in a well-organized monetary system. It doesn't happen. With a country like India, it doesn't happen. With a country like United States, it doesn't happen. In a country like Japan, the money market system is well organized and no individual element in the entire system cannot take chances. So therefore, when you're keeping your money, keep in a well-organized monetary system. I'll tell you one more thing here, role of financial institutions. What are the financial institutions? Financial institutions like LIC, Life Insurance Corporation of India, IDBI, Industrial Development Bank of India, IFCI, Industrial Finance Corporation of India, ICICI, was once upon a time the development bank. Now it is a commercial bank. IDBI also once a development bank. Now it's a commercial bank. Right. So all these organizations channel the domestic savings to the industry. And they play a key role. Yeah, recently also you can look at the Adani's issue. The Life Insurance Corporation of India has invested substantial amount into Adani's shares. When the Hindenburg issue was flared up, the stock prices collapsed for Adani Group Industries. As a result, the money which is invested, the shares which were bought from Adani or in the market, in the stock market, in the Bombay Stock Exchange or National Stock Exchange, Bombay, their value, let us say, if you have bought for 1,000 rupees each share, now when it has come down to 500 in the market, I paid for each share 1,000, which has come to 500 now. And whose money is that? That is public money. You have taken LIC, I have taken LIC. Many people all over the country have taken insurance policies. When small insurance policies, gathered upon, it runs into thousands of crores, even lakhs of crores. And part of those lakhs of crores is invested here. Let's say 50,000 crores are invested in Adani Group, and it has come down now to 25,000 crores. That means the LIC loss, when LIC lost, people subscribed for the insurance policies in LIC, lost that money. Okay, so this is the role of financial institutions. The financial institutions play a key role in driving these stock markets. I'm just telling you only one example called LIC. Okay, and likewise, you have GIs, you have ICICI, you have IDBI, and you can go on, UTI. You can go on analyzing each individual institutional investor. These are called as institutional investors, domestic institutional investors. Then it is also one more important determinant is, it is also important where you want to invest. Where you want to invest. Perceptions do vary from person to person. I always strongly believe that if you invest in food industry, there won't be any loss. I may be 100% wrong. But somebody may think, hey, look at this. If you invest in construction companies, infrastructure companies, you will get faster returns. That is their perception. And somebody may believe, oh no, it is banking which gives faster returns, okay, and good returns. It is different from person to person, which type of industry you want to enter into. And somebody may think automobile is important, that gives more revenues. So it is your way of thinking where you feel that, this gives good return. Again, these things do vary from government to government. If a government comes and encourages infrastructure, the infrastructural share prices go up. And if you're inclined towards investing in such activities, your income also will increase. And other government comes, no, I'm encouraging agriculture, and agricultural produce shares, company shares will increase. So it depends on what type of business organization you're selecting before investing. That's one of the determinants. Fine. Macro household savings and investments. So as per the RBI, about 45 to 50%, the financial assets and physical assets, if you take the ratio, 45%, I'll tell you here one more thing. In India, it is 45% financial assets, 55% real assets. In an American country like American country, 85% financial assets and only 15% of physical assets. Can you imagine that? Again, I'm coming back. 85% are financial assets and only 15% are physical assets. That means the bubble is so vulnerable, the bubble is so, unstable. At any time, that economy may blast. And higher the percentage of your service sector to the contribution of GDP, higher the development is. Let's say the banking, insurance, and financial services, including IT services. IT and ITES, these are all services. there's no tangible production. If in an economy, the contribution of income is more from these services, then that economy is considered most advanced nation. And capitalistic economies, the technologically developed nations have highest share of revenue to the GDP from the service sector. 90% of the income for these companies, for these countries come from the service sector companies. Only 10% come from the tangible goods sector, like manufacturing and agriculture. You know, when I was a student in 80s and 90s, the agricultural income in the total GDP of India was about 70%. At times 67, 69, 70%. And the remaining 30% was coming from the manufacturing and the agriculture. The manufacturing sector, sorry, manufacturing and service sector. Agriculture 70%, manufacturing and service sector coming for 30%. 70% agriculture, 30% manufacturing and service. And in service, only 5 to 7% was the service sector, and remaining all manufacturing. About 22% was manufacturing. Now, today the scenario is changed. About 60% of income, the total income, the national income, comes from the service sector. And it may touch 70%. And the remaining is only manufacturing. That means, we are no longer focusing or interested in producing and farming. If I see some of the villages in Telugu states, there are hardly any labor available or farmers available to cultivate the land. The lands, all children are settled in most of the green pastures like Australia and America. And there's nobody, 100 acres, 150 acres of land is there, but there's nobody to cultivate it. What to do with that? What to do with that? Can you hear me?
Yes, sir.
Okay, I'll continue. I think there is, am I sharing to you? What are you seeing? What do you see? Do you see the content?
Sir,
Content?
yes,
No?
yes, sir. Yes, sir.
Do you see my content?
Yes, sir.
Okay. Because something else, popped up on my screen. Okay. Yeah, form of business organization. Then, yeah, there is nobody to cultivate the land there. So therefore, what is that? We are also moving towards the advanced nations. Then let me come to the next determinant, macro household savings and investment. Modes of investment. Modes of investment. I'm a person who doesn't want any risk. I teach finance. I tried trading in equity market, but I'm not a good trader. Okay, I lost few lakhs of rupees. So I burnt my fingers. I said, this is not for me. For me is because I'm a teacher basically, right? And as a teacher, I can analyze and tell, look at this, all directors, they may be a wonderful directors, but they cannot become heroes like. So I can teach anything, I can analyze to any extent how an investment has to be made, but I myself cannot be an investor. So that's what I realized. So what type of investment you should keep? Equity, all your money, your basket should be comprising of variety. It cannot be only equity, a basket of investment. Look at this basket of investment should be filled with variety. It cannot be only equity. It cannot be only debentures. It cannot be only bonds or treasury bills. It is good that there's a variety. Now, this basket of securities that you're possessing is portfolio. Okay. Now, don't get bewildered when you hear these words. Okay. Portfolio is nothing but the basket of securities that you're holding. Okay, please do remind me if I'm exceeding the time. Yeah, because you had to join back to the next class. Am I exceeding time? If I'm exceeding time, I will stop here. Any of you, can you say that?
Hello, sir.
Yes, ma'am.
So actually, we are having again class at 1 o'clock, sir.
1 o'clock, huh?
Yes, sir. But
And
this
now
class is till 12:30.
no, I'm told 1 hour class, no?
Yes, sir. But the timings which we have got in Excel sheet is from 11:30 to 12:30, sir.
12:30 is over.
Yes, sir.
Yeah, 11:30 to 12:30. 12:30 is over. It's 12:36. It is.
Yes.
Yeah. Anyway, we completed. We understood the investment. We understood the factors determining the investment. Okay. And we'll continue in the next class. And you can take a break. I think they have given you a break.
Yes, sir.
Okay. So you can take this break and we'll join back tomorrow.
Okay.
Tomorrow the same time, right?
Yes, sir.
Okay. Okay. So take care. Good day.
Thank you, sir.
And just go through these pages of your material, then get back to me if any doubts arise. Okay?
Okay, sir.
Right. Good day. Take care.